Hey, sure. Hey guys, my name is Ari. Basically, I'll just tell you a bit about my story, how I got to where I am today. Please, as I'm going, you have questions, let's try to make this interactive. Raise your hand and we can, happy to address them right then and there. So, got out of college, graduated Bentley, wanted to buy my first condo. My uncle, who's a developer, said, Ari, you don't want to buy a condo, you want to buy a 3-family. So I was like, okay, I'm going to buy a 3-family. So I'd saved some money. I was able to pool some capital with a couple other people, and we bought our first 3-family unit, 3-family building in Porter Square, Cambridge, right near the T station. Disaster. New plumbing, new electrical, the whole kit and caboodle, trial by fire, reworking interior layouts to maximize bedroom count, bathrooms, kitchens, the whole deal. My original $75,000 budget ended up being about $250,000. Yeah, so that was fun. Was able to rent out that space pretty quickly, which was nice, even in October. If anyone knows anything about the rental markets, if you miss that September 1 cutoff, you can be in some tough times. So luckily I was able to get it rented out, get the cash flow coming in, make the note payments, and we were off and running. Flash forward about, this was 2007. Flash forward about 6-7 years to 2013. I was like, you know what? The market's heating up. I'm just going to throw a crazy number out here, throw it on MLS and see what happens. So I priced it at $2 million, figuring, who knows? And I get a call from an agent who misread the price. He's like, yeah, Ari, I got some buyers for you. Like, at $1.999 million? It's like, oh, I thought it was $1.19 million. Oh yeah, that's way overpriced. But it is probably worth about $1.5 million. I'm like, okay, that's pretty good. In for $775, about 225 into it. Like, I'm feeling good here. It's like, yeah, you should cash out some money. I called up a bunch of banks, got a home equity line of credit on there for $250,000. Like, oh wow, now I got some capital to play with. Started looking. Bought my second in 2014 right outside of Union Square in Somerville. So skimped and scraped and did what I could to renovate kitchens, bathrooms, cut some corners, rearrange some interior layouts, but did enough to get it rented. Did enough that the bank liked it to give me some more money. So cashed out another about $165,000. Refinanced my first, even more, bought number 3. So now we're at, about 2 years ago, bought number 3, did even more on the renovation side. This was outside of Union again. Bought it, renovated it, leased it, created a bunch of equity, rolled it again. Cashed out about $280,000. So now, it's all sort of paying for itself, which is really nice. Bought the fourth. Fourth was a foreclosure, historical building outside of Sullivan. Decided I was gonna make the first floors into duplexes by renovating the basement. Was gonna do all this work to it, and then I ran into planning and zoning people. They were a ball of fun. But what I was trying to do, they liked, because it was this old, ugly, historical building, vinyl siding, concrete across the whole landscape, and it was such an eyesore that when I went to the historical people and said, look, I'm going to re-side it, I'm going to put on the moldings, I'm going to make it beautiful again, they communicated with the zoning people and I was able to get what I needed done. So they got what I want. They got what they wanted, I got what I wanted, and that was in May 2016. Process took about 7 months. We're fully leased, and it just bought it for $900, put about $750,000 into it, and it just appraised out at 2.25. So got another $300,000 to go play with. Getting approval on that shortly, and on to the next one. Keep it rolling. So that's my story. Happy to take questions about anything related to, smaller to mid-range multifamily purchases, the refinance process, or anything like that before we go to Robert. Sure.
Who do you get to do the construction?
Yeah, so the construction person, super, super, super important. Probably number one is liquidity. Number two is the construction person. You need to find and build a relationship with someone that you trust wholeheartedly. And when they say, Ari, this needs to get done, it's going to cost $15,000, you say, okay, what needs to get done? Why does it cost this much? And then they tell you, and you can just believe them. There are so many contractors out there that you should be wary of, that finding and building a relationship with someone good is incredibly important. Reasonably priced, and will do a good job. They're really tough to find.
So how did you find yours?
Luck. I found my architect on Craigslist, actually. He was doing some side gigs, and it's his buddy, and he came and looked at my second one. He didn't ultimately win the work, but we kept in contact, and he's done my last two, including the historical building that required so much like hand done dental moldings. Just he makes there was a canopy that was from like the 1800s that they'd ripped off when they did vinyl, when they put the vinyl siding on, and he like built that from scratch. And he's like, you know what, Ari, you're good to me. I'll do what it costs for you. So like building a relationship with a contractor is just like so important.
What about management for tenants?
So the question is about management and tenants. I self-manage for the most part. I like to be there to meet them, to show the place. I just meet people and sort of read them, talk to them for 15, 20 minutes about what they do, where they're from, why they're here. And the only eviction I've had to do was through a tenant that I inherited on my second building. Regarding management, myself, and in terms of rent collection, I'm in Cambridge and Somerville. They bend on me money. It's really nice.
What was your funding source for the historic building?
So the funding, I had I put together about $450,000 in terms of cash out money from other properties and home equity line of credit. And the bank actually finances 100%, the commercial mortgage people, they finance 100% of your construction cost. I was there to finance the overruns just with cash. And
have you thought of like the government historic tax credits and all that?
So about historic tax credits, they make it really challenging because they're slow, and I can't wait for them to come in, figure out what they're going to give you, apply for it. If I were to add like some additional moldings that I didn't put onto the building, then that's something that could potentially be financed with the tax credits. Or like we've got a bunch of old concrete steps that they put in like the 90s. The previous owners put in the 90s. Like if I wanted to rip that out, that could potentially be financed through that stuff, but really, really slow. And they want to legislate how you do things, and I don't like that very much.
Can I jump in just on the historical tax credits for
Sure,
a quick
yeah, go
second?
for it.
Because I'm on the lending side, and what we do, obviously you're correct. You have to apply for them, and it's a pretty long process. But once you get awarded the tax credits, what we do for some of our clients, and I'll go into what I do in a minute, but it's kind of a two-part process, is you get a lender and a buyer, and you can create liquidity with those tax credits even right away and use that for equity for your
Can you
project.
syndicate those tax credits to other
Yeah, you probably can, but that's not how we function with them, so.
I've got close to a $7 million portfolio, with a ton of debt, obviously, about $4.5 million of debt.
Would you care to share your bank?
What was that?
Would you care to share the name of your bank?
Oh, sure. Bank, the commercial real estate lender that I deal with is Mike Wiseman at Norwood Bank. Only known him about a year, but in that year, they've refinanced places in Somerville, financed the construction cost of this historic building, and I've been growing up to the, I grew up going to the Cape. I found like the perfect vacation home, and Fannie Mae would never have touched me, and they were able to, through our relationship, help finance that while my debt service numbers, from a traditional bank perspective, were just like way off. So yeah, Mike Wiseman, Norwood Bank. Yeah.
Where do you see the rental market? How do you see that playing out now?
Sure. So where do I see the rental market? In my world is the 22 to 35-year-old person that's renting with roommates. That's my world. That's come out of school. Maybe they're making 50, 60, 80, 100 grand a year, but they're not living on their own. So my world is the $750 to $1,000 a bedroom world. I think.
Are you renting per bedroom?
No,
And then assembling people together, or?
We'll come back. That's a great question. We'll come back to that one. So, but everyone's on one lease. So, for example, my one in Somerville, that's a 4-bed. That's at $3,800 a month, about $1,000 a bed. The high-end market, I'm no expert on that, but if I was a high-end rental place or a high-end condo developer, I'd be a bit nervous, but that's just my opinion. Yeah. Regarding single people and bringing them together. So this most recent one we finished renovating in December 1st, and I had an agent working on trying to list the place as a 4-bed, and that wasn't happening. So I don't wait for phone calls. I put up an ad on Craigslist, singles, $950 a bed, and we had like an open house. And 2 people showed up. They're like, yeah, we sort of hit it off. We're just going to take it. We're going to find other 2 roommates. I'm like, great, leased up. About a week or so later, I had another one of these open house things, like 2 people connected. They just sort of know when they connect with people. Those 2 connected and like, yeah, all right, we're going to take it. We're going to rent out the other 2 rooms. Like, and that's how you rent stuff when you're not from May to September. At least that's what works for me. But like an agent isn't going to do that.
Annual lease?
Annual lease. Well, through 8/30, yeah, and then we'll re-up. But if you're not a hands-on landlord, it just sits.
Furnished or unfurnished?
2 are furnished, 2 are unfurnished. The bigger units are unfurnished. Questions? Cool, great, thank you.
Well,
Oh, yeah, sure.
Are you focusing just on Somerville area? Would you go out or find in that area?
So a question is, do I focus just on Cambridge and Somerville, or do I go elsewhere? The market's really tough right now from a buying perspective. So Brookline's the same way, Newton's tough. I see Roxbury, Dorchester near the subways being a pretty good play right now, especially Roxbury. You can probably get into Roxbury for a 3-family they need some work for about $750,000, maybe a little less.
600, 700.
Yeah, so somewhere around there. And then you add value by maximizing bedroom count and putting lipstick on the pig, if you will. Yeah.
When you say maximize bedroom count, so do you buy like 2 bedrooms and turn it into a 3 or 4?
Yeah. So regarding maximizing bedroom count, all the buildings that I'm looking at, if it's a 3-family and it's got less than 3,300 square feet. It's just not for me. Yeah, so buy someplace that's got some space to it and you just cut up the area. I mean, even a 10 by 10 bedroom is okay. You'd be surprised once you get furniture in there how much room there is.
Turn the living room into another bedroom.
Yeah, if you, yeah,
Dining room,
you need one,
living
yeah,
room.
one, exactly, like one common area and the rest bedrooms. Oh, sorry, yeah, Becky.
You might have touched on it.
Sure.
How did you find
Yeah, so the question, how did I find my deal? So surprisingly, all my deals have been on MLS. I know a lot of people find stuff off market, but they were ugly. They're not turnkey, you know, so it scares off some people. If I were to do it now, I think it would be a lot more, if I were to do my first one now, I think it would be a lot more challenging just because prices have moved up so much. But I think when you look at a property, you have to be looking at it not necessarily from what it cash flows now, but what it can cash flow once you update the kitchens, update the bathrooms, make a second huge living room maybe into 2 bedrooms, make a big closet into a bedroom. I mean, you'd be surprised how much space, how much living space is in a really small bedroom. So yeah, kitchens, bathrooms, maximize bedroom count, and then what will the rents look like after you service all of your costs in your debt?
Are there any limitations on the bedroom count? I mean, do the cities clamp down and say, wait?
Yeah. The question is, are there limitations on bedroom count? Yes, but that can be mitigated in Cambridge and Somerville. It's this thing called a special permit. You get a variance for the parking. And as long as you're creating value in what's in the project that you're doing, I think that they can be more supportive. You may not be able to maximize every space into a bedroom, but for example, the most recent one, I went from 8 legal bed count, 8 legal beds in this 4-unit building to 12. And the bedrooms that they classified before as bedrooms weren't really great. So yeah, there are limitations there, but they can be managed through in the zoning process. I think there's one right here. Yeah.
So how'd you get funding for your first one when everyone knew you didn't know what you were doing?
How did I get funding for my first one is the question. So I'd saved some capital. Some people very close to me were able to support me through that, and I paid them handsomely for it. And like, I'm not looking for any sort of handouts, but yeah, some people that were very, very close to me were able to lend me some money, and I paid them back with interests better than they get sitting in a bank. So it's really important when you're taking on a project to have partners that you can either go into upfront or know that they will be there for you, but it's not free money. Like you're not going to get any handouts. I think there's one over here. Yeah.
Yeah, drilling down on what this gentleman said, most cities and towns have rules about only having 3 or potentially 4 unrelated people living together in an apartment. Have you found that municipalities enforce those rules, and if so, which ones?
Good question. Question is about maximizing bedroom count. The rule that I'm aware of is more than 4. I haven't been in a situation where I've had more than 4 bedrooms in a unit.
Unrelated.
Four unrelated, more than 4 unrelated individuals. Some municipalities, from what I've heard, are more likely to enforce that than others. I think if you say I think if they've gotten into trouble around Tufts because people are throwing parties and drawing attention to themselves. I mean, I'm not going to condone this, but if your tenants are good and you don't have a reason for them for the planning, zoning, building department to be around, then I think they're gonna leave you alone.
Do you keep these all as apartments, or do you ever condominium them?
Question is about condo conversions. I'm a buy and hold person. But from an investment standpoint, I'm looking at looking at what is my exit strategy to the extent I need to exit, and you don't want to be over investing in the interior where you're not going to get paid back for it on the other end. So it can be challenging to sort of find that middle ground in certain markets. Cambridge and Somerville, no matter how much money, for the most part, no matter how much money you put into it, your returns may get squished a little bit on the flip, but you're gonna come out okay just because the price per square footage is between $5,000 and $1,000 a square foot, depending on where you are, and your renovating costs, your gut rehab costs, shouldn't be more than 100 or 120.
What kind of return do you like to get? So if you buy like a $600,000 house, what do you want for gross income?
Sure, great question. Questions about if you buy a property, what are you looking at in terms of gross rent? So my rule of thumb, just back of the envelope, is for every $1 million of investment, you need, depending on what your hurdle rates is, at least $6,000 a month in rent. That's like super, super low. 8 is good. Like $1,000 for each $1 million of investment is like home run. But that's like the back of the envelope, and it depends market to market. Tougher or more challenging markets like that aren't Cambridge and Somerville, where you may have tenant issues, you'll need a higher. You'd want to be getting a better return than in areas where you don't have like those rented and collection and vacancy issues.
So did you say 100,000 or $100,000? $10,000 in rent per $1 million of investment is a home run for the most part. For the most part.
Were you able to eyeball the extent of the renovation on the last one you did, or did you have a contract?
So question is about renovation and if I was able to estimate cost on construction. I walk through all my properties with my contractor. I'll look at it, make the determination if it makes sense, then I'll bring him in and we'll just do a walkthrough. My offers are no mortgage contingency, no finance contingency, no inspection. So I like to have my contractor come and look at it beforehand.
Do you have certain days, contingency, like working days for them to walk through?
Yeah, typically I don't even want to write that into the offer. Like I'll have them look at it like the day of or the day after, and we'll walk through it. The thing with this most recent building is I was pretty spot on with the initial estimates, and then these silly historic people wanted all this extra stuff, and that really killed the budget. Plus, there was some stuff related to running water lines and rotted wood on vinyl. You never know what's under vinyl until you rip it off. And like the whole soffit was rotted, all the siding was rotted. I was planning on being able to salvage some of that stuff. So in these older buildings, which is typically what you get around Cambridge and Somerville and the greater Boston area, especially if there's vinyl, you have no flipping clue what happened, what's underneath there until you rip it off. So yes and no. I guess someone else? No? Anything else before we go to Robert? All right, thanks, guys.
There's really not much else for me to say. But thank you to Matt and Ben and George and everybody for having us tonight. I think it's a great group to get together and talk about multifamilies. I'm going to speak a little bit differently though from the multifamily side, just from the standpoint of the actual hard assets. I think you really touched on all that pretty well. I happen to be on the finance side. I did go to Bentley as well, and I did own property in this area. I actually used to own 203 West Newton, which is now two duplexes and a single, and it was a 5-story brownstone when I owned it. So But in terms
Do you
of,
wish you held it?
well, we had that conversation, yeah. The story, guys, is I bought it for $650 15 years ago and sold it in a year for $950. I was a guru. You all know what it's worth right now. So.
We're listening to him.
Yes. So anyway, but thank you for having me. Just a little bit of background on myself. Again, I went to Bentley. I have a Kellogg MBA. I started out in the business at Lehman Brothers for the first 10 years. The first deal that I cut my teeth on was the Rockefeller Center Properties deal, which was one of the first publicly traded REITs. I was on the equity raise team. We raised $750 million to fund the REIT offering. It was about a $3 million deal, $3 billion deal back then. Anyway, long since then, and I'm kind of fast forwarding because that was the early 90s and probably before you were out of diapers, but we since then worked at several Wall Street firms, and then fast forwarding to 2006, launched a company called AmericaVest. We invested in whole loan mortgages, pre-securitization, distressed debt, bought that, worked it out, invested in that, and then the market crashed, as we all know, in 9 and 10. Muddled through that and reemerged as a mortgage REIT, a commercial real estate mortgage REIT. We have been doing commercial real estate lending throughout the period of our prior funds. Raised about $100 million for that fund, and we did bridge, pref equity, and mezz lending. Lo and behold, it got acquired by a public company, a company called Omega Commercial Financial down on Brickell Avenue, Miami. So, kind of quasi-retired, came back to Boston, was living in Fort Lauderdale. I have my own firm, which is a consulting firm called Metrics Capital. What we do is we help with structured finance. I find a lot of investors, as they move up the food chain and start to grow their businesses, someone like yourself, let's say, you say, okay, hey, this is great doing 3 families here and leveraging it up with my bank and doing that, but hey, how do we launch a fund? How do we raise an LP? How do I structure a REIT maybe and do something different? How do I create liquidity where there isn't any in real estate, and there are ways to do that. So I help on a consulting basis for that with some of my clients. But I think what's most germane to this conversation today is our lending capabilities. Gertica and Company, does anybody here know the name HFF? You know that name, right? Okay, one of the largest intermediary firms in the world, if not the largest. They're a publicly traded intermediary firm. I think Newmark said they're going public. Yeah, they are. But they're one of the largest traded, largest intermediary firms, and the founders of HFF, one was John Fowler, you may know him, he's a local guy. Well, Peter Gertica helped found HFF and then broke off. So Gertica is a great firm, small shop, we're a boutique, kind of a private firm, but we can help you, excuse me?
No,
okay, we can help you with all your needs in terms of financing. And I don't answer questions on interest rates, guys, so don't ask. But on what the rates are on the loans, they're all different. But we can help you. What I act as, and what the firm really steps in, and we act as, let's say, your capital markets team. You've got enough to do between collecting rents, renting the place, finding things, working with contractors, to now have to go out and fill loan applications and figure out, where you're going to get your money, and maybe not having as many sources as. Beyond, let's say, the debt and bank, okay?
Norwood.
What's that? Norwood Bank, sorry. Close. All right, kind of in the air. We work with, we have at our fingertips, 20, 30, 50 banks, probably more like 50 banks. We work with life companies, insurance companies, life insurance companies. We work with pension funds, all of them that are interested in putting their money out and capital out in attractive investments in real estate. And that can range anywhere from, retail, if it's the right retail these days, office, definitely multifamily. I mean, multifamily's the darling of the space of commercial real estate property these days. And whether you have a value add strategy or adaptive reuse strategy or whatever your plan is, we generally have a capital source for that. We have sources that will buy discounted paper. So if you find a property and you can buy the paper, and then take that property back and own the property. There's a lot of really creative and unique things that we can do, but we're a very strong powerhouse with a lot of great connections to help you fulfill your needs. If you're starting out, maybe your local bank and your local bank connections are good. would be helpful, but certainly, construction loans, whatever, even refinancing. I mean, if you get to the point where it's time to refinance, a lot of what the clients that we're working with now are looking at is, hey, rates may be going up. So if I'm getting closer to the end of a loan and it's an open loan where maybe I have no prepay penalties or whatever, can we lock in a longer term loan here at these rates that's gonna take me 10, and in some cases, we're working with insurance companies that'll go 20-year terms, things like that. So locking in some of the longer term rates if your plan is to hold on a longer term basis. So again, what I have to say is probably not nearly as exciting as what Ari has to say. I'm here, and I hopefully can answer any questions or help you guys, as long as, again, there's no rates on, any questions on what the rates are. Go ahead.
Number of days of processing.
I hate to say this, and I really got to say, every deal is so different. Really. I mean, guys need deals done. We got to get done, and we have to close. We got this deal. We need to close in 3 weeks. We need to
Right.
close in a month.
Right.
Can we hump and get it done? Yeah, I mean, that can get done. 60 days maybe is depending on, no, too long, so it all depends on the transaction, but, I think a broad window would be
30 to 45.
30 to 45 days. Yeah. Yes?
What's the down payment?
Well, it depends on the asset. I think if you're looking, through the entire capital stack, if you're looking at a multifamily property and you're gonna go with a more traditional lender, you're probably looking at, 25 to 30% down. I get a lot of questions about equity. We do have access to equity as a firm. But if I were to raise, everybody in this room, who would like to get some additional equity? Let me see a show of hands. Okay, everybody, right? So what happens is, though, the equity deals that we do are only the sweetest deals. And so, not to suggest that every deal in here isn't the greatest deal, but understand that that's a very select group, so we can raise. If you're looking to raise equity, and if you have the sponsor equity and you're looking to maybe JV it or syndicate it or whatever, or bring it to a firm like us to help you do that, you got to kind of figure you got to have at least 10% of the equity in the capital stack, at least to start a conversation about raising equity. And then you do the diligence on the deal, see what the deal looks like. Does it have the legs to go to the street and say, we want to bring our investors in from an equity standpoint. But to answer your question, and the question was, what's generally what you need to have as a down payment? 20, 30%, 25, 30%. And that can always move around too, because as you're levering up your assets, that changes to a degree as well, and you have a bank relationship. Yes?
Question with banks, when you go to a traditional bank, they want to look at your income, your other debt, like your car payments and all that. Are you looking at the payments just for the property that you're financing, or are you trying to look at a whole picture for the individual with other debt that person might have?
We're really looking at the whole picture. I mean, we want to know what your PFS is, what your history is, and again, your personal financial statements. Because if we're gonna fund a multifamily, it's really gonna be based upon what the NOI is. Huh?
Personal guarantee.
Sometimes a personal guarantee. If you've got a great track record, a guy that's been doing it for lots of years, done lots of deals, and you've got a real history track record. A big part of this, when you start to move up the food chain on deals and deal size, is what's your track record? How have you done? I mean, there are lenders out there though that even guys that have filed BK, as long as they did what they could to make the deal right, you can find lenders that will lend. I mean, they're going to be expensive, but they'll do it. So, in answer to your question is, it's really kind of a whole picture. I mean, your first 3-family, if did you buy that as a residence?
Mm-hmm.
Is often bought as a residence. I'm going to live there. So now they're just going to look at you, what's your job, what's your income, pretty simple stuff. So.
Yeah, but to dovetail off of that question, if you move, or when you move from the residential mortgage to the commercial mortgage, it's a lot about liquidity, not necessarily your personal earning potential, but liquidity, and if the property can debt service coverage, 1.25.
Right.
One and a quarter times. And loan of value, liquidity, and debt service coverage.
And debt service coverage can be different depending on the lender, but 1.25 is a pretty good rule of thumb to look for debt service coverage ratio. Yeah. So, yes.
So I just want to clarify one one before I go ahead with my question.
Okay.
The 10% you said is when you're raising equity, that's where you need the sponsor to have 10%, then you would raise the equity?
What I'm saying to you is, and it's not even a hard, fast rule, I'm just telling you that whenever we have someone come to us and say, hey, I want to buy a 20-unit building, okay? And, you know, it needs $2 million in equity, all right? Well, then, great. Well, to have a conversation even about whether we could even consider that is, you know, using you as an example, if you got at least the 200 grand, 10% of that equity capital stack. Yeah.
Okay. And do you lend in all, like most states, or is there restrictions? And what is, like for multifamilies, what's the minimum that you lend?
We put out $1.5 billion in the last year in loans. We intermediated, brought, you know, the lenders, whether it be life insurance companies, banks, or whatever, to our borrowers. But it is mostly on, I would say that we know this market well. We know Florida well. I lived there for 15 years. We're able to execute well in those markets. You know, I'm looking at a deal right now, I mentioned to you earlier, up in Saranac Lake, New York. It's a very different market, but it's one where we can execute if we choose to do so.
Families on the commercial side, or is it any commercial?
Anything. This is a hotel construction ground up. The sponsor is a world-renowned sponsor, and I literally, you know, he'll going to put a ton of equity down. We'll just put a small piece in, maybe 30% of the capital stack. But at the end of the day, you know, he won't have to put all the capital out. Very unusual market up there. It's a vacation area. But no, it's across the board, most everything. Value add, adaptive reuse, multifamilies. You can talk about office, retail. We look at malls. I mean, everything. But everybody knows what's happening with retail now. I mean, enclosed malls are very hard to finance today. Very difficult. I have one right now in Florida, and they can't get anybody to put any money in. It's got 25%.
Florida. I grew up in South Florida.
Did you? I don't. It's not. It's a real estate guy who brought it to me, and it's in South Florida. I used to live in Fort Lauderdale area, so. But it's very hard to find. It's 25% vacancy rate. I think the rent per square foot is like, you know, $6, and it's really low. So yeah, it's really, yeah. So it's not in good shape. So and it's low, and the rate, and you know, we're a middle market firm. So, you know, if you tell me you've got something, you want to borrow 500 grand, well, okay, technically that fits. But when you're behind $1.5 billion worth of loans at 500, you just don't get a lot of attention. Our average loan is 13 million, which isn't that large. So that means we did some at 80 and 100, and then some down at, you know, $2 million. So it kind of gives you a feel for where we might be able to help you. Again, look at us in a way that, you know, we can be your capital markets team, because the capital markets in and of itself is a job. I work with some of the people here in this room, and I know there's a lot of good professionals here. I work quite a bit with Roberto. I know Roberto's got an 8-family out there for sale. That is kind of attractive, right? So anyway, but that's any other questions? What else can I answer for you guys? Yes.
What's your typical, I mean, they comment on rates, but your term, do you usually go out 20 years?
A 10-year term, yeah. I mean, I think that's on average a good number. But as I mentioned to you, some of the life companies will go further out.
Types of
Covenants.
in the agreement, for instance, fixed charge coverage, if your coverage goes below a certain rate.
Oh, yeah.
It's not, you can get mortgage, but it.
Right. Debt service coverage and all that. Yeah, absolutely. Yeah, those things all come up. Depending, every deal is different. So, you know, we do have those though. And again, because remember, we're not working. It's not just us as a bank with what we do. You know, if I work with Aegon, or if I work with your bank, they have different contracts. Yes.
Where does the fee for your company come from?
The fee is paid for by the sponsor. It's usually about 1%. But you know, if we can help you, we can help with the rates, excuse me, and we're able to create a good transaction for you. Usually it's baked in and we pay for ourselves. So, all right, yes.
So, like, I'm trying to do the exact same thing you're doing. I'm brand new. I know you said Roxbury before, like Dorchester. Where would you recommend, like, a brand new person starting out?
So liquidity, obviously, super important to have cash or have someone that you can lean on either as an equity partner or as a debt partner that's not gonna let you fail. Because that could be pretty catastrophic. But let's not harp on that. But it's really important to have partners. So if I were starting out now, I would be looking at stuff that's a bit ugly near public transit. If you look at what the South End was, 20 years ago, it's what parts of Roxbury look like now. So there's an opportunity, as long as you're within, half mile, 3/4 of a mile of public transit. I think that's a good proxy to use in most parts of this Metro Boston area, because that's where my bread and butter, the 22 to 35-year-old wants to live.